A crucial Reserve Bank of India board meeting comes up on November 19th, where the government, its board members, is expected to raise possibly 4 crucial issues, among other issues, of course. First, the Reserve Bank needs to bring down the minimum capital that banks need to maintain. 2, Reserve Bank needs to provide more liquidity in the market. 3, Reserve Bank needs to ease the filters which push a bank into prompt corrective action. And 4, Reserve Bank needs to provide special dispensation to small and medium enterprises, to SMEs. To discuss the pros and cons of some of these, I have with me Hasib Drabu, economist, former banker and former State Finance Minister, Mr. B. Mahapatra, former Executive Director at the Reserve Bank of India, and Ashwin Parikh, the well-known banking expert. Before I go to my guests, let me just mention what we mean by minimum capital requirements or what is called the Basel requirements. Under the rules made by global banks at the Swiss city of Basel in the 90s, all banks have to keep minimum capital of 8%. Also, part of this 8%, that is 4.5%, has to be common equity, that is shareholders' equity. India, on its part, requires 5.5% as common equity and 9% as overall capital. Basel requires 8%. Now, India requires 1% more on all categories. The Reserve Bank's reasons for these over the years have been that, 1, in India, losses for banks are higher when loans go bad because the judicial system is very time-consuming, the time value of money erodes, and transaction costs like stamp duties are also high. These ensure that banks don't realize the true value of assets when they sell off a defaulter's collateral. The Reserve Bank also says that in most countries, the capital requirements are higher than Basel rules. For instance, in Mexico, in China, in South Africa, Turkey, in Singapore, the capital requirements are between 9 and 11%. So India is not alone in requiring more capital than Basel. Let me go to my guests on this issue. First up, Hasib Drabu, what's your sense? Do you think Reserve Bank is becoming way too strict in capital requirements?
No, let's understand this in a certain context. That we're talking of 2 different things here. The reason why your regulatory capital requirements are higher than Basel and have been so is because the prudential norm system is not as robust as elsewhere. For instance, the basic issue of coverage ratio. The RBI has still not stipulated, at some point did stipulate, that you must have X amount of coverage ratio in a bank. You know, there are banks operating with 100% coverage ratios. We have banks operating with 35% coverage ratios. So there is a link between the regulatory part and the prudential part. I think we need to look at strengthening the prudential part before we strengthen or weaken or reduce the regulatory capital requirement. Second, we are operating in an economy which has a large informal segment, where credit flows are confidence-based, relationship-based, not credit history-based. You don't really have a credit history of accounts that you would have elsewhere. So the kind of lending that happens is in quote-unquote a certain intuitive relationship. It's not really. There are so many businesses where balance sheet lending doesn't happen. We're not only talking of the top 400, 500 corporates. You're talking of the SME segment, which don't have good, strong balance sheets, right? But they have good businesses.
Okay.
So when you look at the entire lending pattern, then you feel that to have a higher capital requirement by 1 percentage point, 100 basis points, I think is valid. Now, you may want to re-examine it, but while you do so, you need to understand, A, the stage that you're in, when a cleanup is happening, when a solvency code has come in, when NPA problem has surfaced, because of lack of action for very many years. So that is how you would want to arrive at this, rather than just take a Basel versus India position.
Okay, fair point. Mr. Mahapatra, of course, you were present at the creation, as it were. You were in the Reserve Bank in the 90s and in the 2000s when it was implemented. So very quickly, has Mr. Drabu covered all the points, or do you think there are other reasons why Reserve Bank is keeping the 9%, or are you in the camp that 8% is fair?
Yeah, Mr. Drabu covered many points, but I just want to add some other dimension to the whole issue. First, this Basel norm of 8%, it came from the point of view of G10 countries initially.
Yes.
So from the point of view of advanced economies.
Yes.
So actually, they were the members of Basel Committee only till the global financial crisis of 2008.
Okay.
When it was expanded to G20, and India also became a member of the Basel Committee. Before that, it was a club of G10 only.
Yeah, but India accepted the Basel rules.
Yes. I mean, India and also many other countries.
Yes.
So the question is, this Basel 8% is really not a science. It is not like physics or chemistry, not like a natural science. It is a calibration.
Okay.
It is an average concept.
Okay. But are we over calibrating or calibrating to the higher end is the charge from the government?
Just listen.
Yes,
I'll just finish it. This is a calibration. This calibration was done based on the data supplied by these G10 countries.
Okay.
And as you know, in those G10 countries, the interest rates are low, the volatility of the rates are low, the recovery procedures are very fast, and the loss given default is low. So based on all these factors, this 8% was calibrated.
Derived. Okay.
And when the Basel II came, it applied external rating agencies rating to a loan.
Okay.
So based on that rating, the risk weights are calibrated.
Yes.
If it is AAA, maybe the risk weight will be 50%.
No.
If it is AA, maybe 75%.
Yes.
Or lower the rating, higher the risk weight.
Yes.
So these risk weights, again, calibration was done based on the risk weights or the ratings by Standard & Poor and Moody's.
Yes.
And Standard & Poor and Moody's have a long history of data. Whereas in our country, we depend on the rating of our domestic rating agencies, which do not have that long history.
Okay.
So the calibration could be different. Suppose the same loan exposure, which our domestic rating agencies have rated, if it is given to Standard & Poor or Moody's, the rating could be different.
Okay, fair point.
So based on that, ours is a very, the calibration is very close to the reality, and I think 9% is good enough, and it has stood the test of time for us.
Okay. Well, I'm trying to rush you so that I can get other points discussed as well. Mr. Parekh, what about this argument that, international banks which have international exposure need to follow international rules? Those banks which only serve domestic needs can be allowed to come to 8%. Will that work, or will there be a problem opening LCs?
No, I don't think that's a very valid argument. Let me articulate my thoughts. In addition to what Mr. Drabu and Mr. Mahapatra said, and I'm entirely endorsing the view that the regulator, if he has decided for this market that in comparison with Basel norms, 9% is a better norm, then the regulator is all the justification in doing so. Let me just add another dimension to what has already been said. One is, let's look at the leveraging of the balance sheet.
Okay.
Let's say, 8% you are leveraging 12.5 times. At 9% you are leveraging your balance sheet 11.1 times, which means you are exposing your deposit holders more to the risk, let's say, compared to what you would have done at 8%, for instance. So, that's the additional dimension that I would like to bring in. The regulator has to look at two things. He has to protect the deposit holders' interest, and he has to certainly look at the stability of the banking system. And I think from both those perspectives, 9% to my mind is actually, I mean, now with the NPA scenario and with the NCLT going so bad, I mean, in a sense, so long, not even bad, you know, I would certainly say that even 9% could have be reviewed to a higher percent, you know.
Yeah, I think Reserve Bank was thinking of doing that, but they have just held out and not increased the capital lately. Otherwise, it was supposed to climb a little higher. But Mr. Mahapatra, finally, before we go to the next point, is there a case to keep a separate number for the banks that serve the domestic market? Keep that at 8%, but internationally facing banks at 9%?
I mean, if banks are like cooperative banks or regional rural banks, we might have a different standard because they are really not exposed to international markets.
Okay.
But other commercial banks, even if they are domestic oriented, their customers may be exporters or importers.
Okay.
So they have exposure to the outside world. And the LCs opened by them will not be accepted by external parties.
Okay.
So there, I mean, we stand to lose, I mean, business.
Okay.
I mean, our customers will suffer from that point of view.
Okay. Well, there are a few more points that board members in the Reserve Bank have been making in the public domain. I have to take a break. I'll come back and ask you your reactions on those as well. Hasib Drabu, of course, economist, former finance minister and former banker. Ashwin Parekh, well-known banking expert, and B. Mahapatra, former executive director at Reserve Bank. There is an upcoming board meeting of the Reserve Bank on November 19th, where the government is expected, through its members, to raise some important demands on the Reserve Bank. We just discussed the demand that capital requirements be brought lower. The other demand is that there should be more liquidity. We have just also heard in the public domain Mr. S. Gurumurthy, one of the board members, saying that the FRBM is restricting the government from providing liquidity through fiscal deficit. And in a country like India, in this stage, even Japan allows it, had been allowing it. India should allow for more fiscal deficit, basically allow the government to create liquidity. Hasib Drabu, your thoughts?
Look, let's not react to a board member's statement in public, but it could be a legitimate point of view of the government that you will run a higher fiscal deficit to push up demand. Now, this has nothing to do with the Reserve Bank per se. It's a fiscal policy decision. What will come into the domain is, do you want to monetize this fiscal deficit or not? Running a high fiscal deficit is a budgetary prerogative. It has nothing to do with the Reserve Bank of India. It is a budgetary exercise which the finance minister will run. Now, do you want automatic monetization of ad hoc treasury bills back, what was in the late 80s and early 90s? Is it deficit financing bringing back? Now, that's a separate debate.
Do you think
Today,
that
the government is well within its right
to increase deficit? But Hasib, what I'm asking you is that can we go back to a time of even higher fiscal deficit, because the bond markets are reacting very negatively to it, and at the moment at least 5-6% of the bonds are held by FIIs, and of course you know, we have market driven rates. Do you think we can go back to monetizing the deficit?
No, I don't think we can. What I'm saying is there's a simple issue that I'm trying to point out in the overall context of the debate that's happening, that the government is well within its rights to increase fiscal deficit. The monetary policy will accommodate, adjust, or it could be at variance with a higher fiscal deficit. It's not unknown in this country to have run high fiscal deficits, showing an expansionary fiscal policy, and yet have a contractionary monetary policy. There have been years when that has happened. So let's not kind of complicate the existing debate with this. Whether you want to go back to an automatic ad hoc monetization, no. But you can certainly look at having a monetization number in the budget in consultation with the Reserve Bank of India, which can be put in. Now, you don't need to go back to ad hoc treasury bills, which is a disaster, because you would then run, you know, I remember daily deficits were 20 times, 30 times the budget number, and for one day, adjustment would be made.
But
so, in a sense, let us in some way,
let me just get Mr. Mahapatra in. At the moment, we also have an MPC. Now, the MPC has a given target of 4%. So, if you have a deficit that is very high, obviously that will exacerbate inflationary pressures, and the MPC will have to run a very contractionary, a very tight monetary policy. So given that we already have an MPC regime in place, Mr. Mahapatra, can we even think of removing FRBM limits?
I mean, theoretically, even if they do and make fiscal more expansive, then MPC, as you rightly said, they will raise the interest rates. Then who will suffer? The entire economy will suffer. The borrowers will borrow at higher rates. They will not be able to service the loans at higher rates. NPAs will again increase. Common man like you and me will suffer. Will buy our groceries and vegetables at higher rates.
Prices.
So, I mean, it's a no win game for anybody.
Okay. All right. Just let me pursue this point a little more. The Reserve Bank already this year has done open market purchases of 1.26 lakh crore of bonds as of November. Chances are they will run that kind of a policy even in December, and another 40,000 crore may come as open market purchases, simply because for the Diwali week, we saw currency in circulation increase by 50,000 crores. So, I mean, there is serious withdrawal of cash from the system. Chances are 40,000 crore of OMOs will be done. Hasib, does that suffice? Or is there something more like a CRR cut that the Reserve Bank has to do?
No, you see, again, I mean, the Reserve Bank of India will determine the OMO. People will have a point of view on doing open market operations. It's a legitimate instrument, can be done in the first phase. I would think it is, if it's not about a specific directed liquidity issue for a sector like NBFC, but you're looking at a general liquidity constraint, yes, there can be a case for a staggered CRR reduction, that you could do a 50 basis points over 6 months with every week. That has been done traditionally. It's nothing out of thing. Again, now here, who has the mandate, whatever are issues that can be debated. But if there is need for liquidity, which it does seem that there is need for liquidity, not just for a sector, but the entire economy, then a legitimate instrument would be a reduction in the CRR, but not, a kind of a large cut, but a staggered thing which will allow the economy to adjust to newer levels of liquidity.
Okay. But you're quite clearly against any line of credit to NBFCs, any sectoral credit.
No, you see, again, the issue is
I'm
that
asking you.
There can be need for... Personally, yes. I mean, personally, yes. I don't think you should address through such large policy instruments. The Reserve Bank should be addressing sectoral things. We have moved away from that. But I also believe that there is need for liquidity in the system in general, not just NBFCs. One is aware of banks having liquidity constraints now. So for that, you have well-established principles of reduction in your cash reserve ratio or other forms where you can do it, and do it in a manner which will allow the liquidity to get transmitted to various sectors.
Okay. Mr. Mahapatra, what would your sense be? Should the Reserve Bank think of not just OMO but also CRR cuts, and more importantly, any special dispensation to the NBFC sector?
See, first, Reserve Bank has all the data and the information to take a call whether this liquidity problem is frictional, that is temporary, or it is structural or durable. If it is, temporary or frictional, they have different instruments to handle OMO, report.
May I interrupt you, sir? May I interrupt you, sir? Since you were in the Reserve Bank in 2008-9, you remember that there was this SPV created which had Government of India bonds, and in exchange for the bonds, the Reserve Bank of India gave first 20,000 crore of money, and that was given over to the NBFCs. But it was backed by Government of India bonds. So RBI did create that kind of a window. Should that be repeated?
In any case, RBI cannot lend on clean basis.
Yes.
If RBI has to lend, it has to be backed by government securities.
Okay.
So the law doesn't permit RBI to lend on clean basis.
Okay.
And I mean, I mean, I don't have the data, and I mean, I don't know really if there is a liquidity problem, and RBI should be awake to the issue.
Okay. Well, we are being told by debt market participants that the crisis or the inability of unwillingness of mutual funds to roll over NBFC credit is not as dire as it was in October. Most of the CP redemptions have been either the redemption is smooth or they have been rolled over so far. But okay, that's a debt market issue. Let me come to the third problem that is being discussed, that a special dispensation is needed for SMEs. I do not know what is in the mind of the government or the Reserve Bank of India board members, but the two things that I can think of is maybe a 180-day line for NPA recognition, or maybe lower capital requirements for an SME loan. Ashwin Parekh, is that something one can go to? More lax or some forbearance for SMEs?
Well, actually, if you really look at the entire issue, I mean, of SME funding, there are a lot of lot of structural issues associated with funding the SMEs. I mean, and there, of course, one must agree with the point that between the banking system and the NBFC sort of para-banking arrangement, the NBFCs have been a little closer to MSCs and SMEs so far. So to that extent, I mean, I must say that there is an argument with the government to say that the banking system must go closer to the end and open up more lines for, let's say, the SME and MSME sector. But the argument, is that should it be a knee-jerk kind of an arrangement? Because, I mean, we know from the data that both the regulators and the banking system has, that the NPA and recovery management in case of SMEs is a little more, because the extent of, let's say, secured loans that the SMEs can really have, is much less as compared to, let's say, the other sectors, I mean, mid-size and large corporates, let's say in that case. Yeah. So therefore, to that extent, I mean, I would say knee-jerk is something that is avoidable, but I do take the point that in the medium term, in the long, the banking system should go closer to SMEs.
Okay. Well, actually, Uday Kotak, sometime in the a few months back, even raised the issue whether already, the Indian banking system is way too lax with SMEs. He was doubtful whether the inventory or the stocks that the SMEs or MSMEs are supposed to have are actually there, and whether they are even overestimated or overvalued. What would your thoughts be on this, Hasib Drabu? Special dispensation to SMEs, is it called for at this juncture, and how should it be done?
I think that's the important point. I mean, I think there's no denying the fact that SMEs in this country are by and large credit starved. They don't get the kind of credit that they ought to have, given their contribution to GDP. If you look at the numbers, then you will see the credit that goes to SMEs is very, very marginal in terms of the overall credit pie. I think that's without doubt. That again goes back to my first point, that Indian banks are doing balance sheet based lending, which SMEs don't have. So you need to do other forms of lending, and asset based lending is what is being done with SMEs. Okay. Is this the right time to do it? A. B. Is this to be a specific policy initiative? No, I don't think that should be done. Okay. You need to do structural reforms so that banking sector does lend to the SMEs on a profitable basis, and ensure that a certain line of credit is, but it should not be as if you are doing a package. Now, this has come in the context of the fact, again, there is no denying the fact that there is tremendous amount of distress in the SME sector, driven by monetization and GST. Yes. Both have caused the problem for SME sector. Now, the government should look at other issues where SME distress can be resolved.
So it's a fiscal bureaucratic policy. It's a fiscal bureaucratic package.
It is, yes, or just even taxation. I mean, look at how GST has gone. The reverse charge mechanism is not there, composition scheme is not working quite adequately. So let us look at it in totality rather than just look at Reserve Bank doing a package for them. I think it's as Ashwin rightly said, it can't be a knee-jerk thing. There is no denying that there is distress in the SME sector. There is no denying that credit must flow to them. But should it be done in this fashion? I would have my reservations on it. Okay.
Last word from you, Mr. Mahapatra, on this. SMEs, should Reserve Bank be told to change any rules?
See, SME, to my mind, their money gets stuck when they supply to large industries.
Yes.
And the large industries don't pay the SMEs in time.
They created the trades for it, but not everyone
so,
is listed on the trades exchange.
Yeah, that has to be activated. That should be activated. And so that, you facilitate and the return flow of money to the SMEs when they supply to large industries.
Okay.
That has to be facilitated. That is, RBI tried doing it. It's still in its infancy. But structurally, that is what is needed.
Fair enough.
And in addition to that, as Dr. Dabru pointed out, they don't have proper balance sheets. So probably they have to be brought to the formal economy system, so that they have balance sheets and they have proper accounts, so that bankers will be willing
able
to
to
lend
assess.
them.
Yes. Fair point. Gentlemen, thank you very much for your time. Key takeaways from my guests. First up on Basel, I think it was unanimous. They don't want capital requirements to be reduced because India is different in terms of the ability of banks to get back collateral from a defaulter, the legal system and the transaction cost being high. On the issue of SME packages, the packages should come more from the fiscal authorities in terms of tax benefits or other facilities, extra facilities that SMEs can be given. Asking the Reserve Bank to put in a package in a knee-jerk fashion is certainly not the way to go. It will endanger banks. The third point was on whether more liquidity should be given. Certainly not a fiscal deficit that is monetized by the Reserve Bank, but maybe a CRR cut at an appropriate time, but that is something which the Monetary Policy Committee and the Reserve Bank has to decide. That's not something. Liquidity, yes, desirable, but that's something which should be left to the judgment of the Reserve Bank itself. That's the key takeaways from my expert panel. Thank you very much for watching this edition of Indianomics.